Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So the market is making some wild swings here, but we're really not going anywhere. Ever since the 22nd of September, we've been pretty much swinging up and down, but going absolutely nowhere. Now, a lot of people will tell you, this is the market consolidating the losses that we saw throughout the month of August and September. Now we're seeing this consolidation pattern, and we're about to go a lot lower and see the real part of the crash. Now let's pause and think about what could trigger that type of thing. Now, the Fed could continue spooking the market. I personally think a lot of that has been just been priced in throughout 2022. That's just what the research that we've conducted at Game of Trades suggests, that essentially a large part of the tightening cycle is behind us. And yes, of course it can continue for some time, but the point is it's not going to trigger a massive market collapse. So what has throughout history systematically triggered market collapses? I'm just going on a weekly chart here, and that is a real recession. Now, a lot of people are saying, oh, we're in a recession right now, so we should expect the market to collapse now. Perhaps we are. A lot of very smart people are saying that. So that's an opinion that you have to respect. But the truth is, if we take a look at the unemployment rate, we haven't seen yet, at least, the true signs of a rising unemployment rate, which is typically what you see leading up to a market top. You see, at the very least, the unemployment rate begin to trend up, showing a little bit of weakness and then an acceleration. And so this part right there, that's not priced in. The Fed is probably priced in. This, a recession with rising unemployment, that's definitely not in the stock market's price. That would be the equivalent of a real recession, a collapse in earnings that could lead the market significantly lower. If we take a look at severe bear markets, 1981 to 1982, may not look like much here. This was, first of all, it was fueled by a rising unemployment rate right here. It lasted 2 years while inflation was at around 20%, right? So not only did you see a drop in the stock market of around 26%, but throughout those 2 years, you also lost 20% of your purchasing power per year. So that period, just that small area, might not look like much, but it was huge wealth destruction. 1974 right here, that was really the other iconic bear market that we had. In my opinion, we've had 4 real bear markets throughout the last, recent financial history. Now you can go back to 1929. That was obviously a very tough period for anybody in the markets. But in recent history, assuming that, we've learned from the mistakes of the past, which is a completely other question, but we've only had 4 real big crashes, 4 real big moments where the markets were tanking down. And in all 4 of those, you did have a real recession. You did have a rising unemployment rate, 1969, 1974, 1981, 2000, and 2008. That's what could trigger a market collapse. You have to think about this. What does the unemployment rate look like perhaps 6 months from now? Because the market is essentially pricing in what happens around 6 months from now. Are we going to start to see a V-shaped type of look on the unemployment rate? It's possible. That would trigger a market collapse. So we're going to talk about that in this video and try and give you guys a different perspective on everything that's going on. If you enjoy this episode, don't forget to smash that like button as hard as you possibly can, and also subscribe to the channel if you haven't already. I want to quickly remind you guys that we have a special offer of a 20% discount for our service at gameoftrades.net. We don't do these types of deals very often, so make sure to take advantage of it. Our mission at gameoftrades.net is to produce institutional level research, but in a format that is comprehensive, accessible, and actionable for really investors of all skill levels. We think we're truly doing something special here, hopefully democratizing superior research and giving access to more people around the world. And that is really all thanks to you guys, to the YouTube community. So for the 2-year anniversary of gameoftrades.net, we are doing this discount that's only going to be available for a limited amount of time. Now let's get back to the video and, as usual, talk about the catastrophic events that may or may not be ahead of us. What's one of the big signs of a recession, right? And when I say recession, I don't mean two consecutive quarters of negative GDP. That's just, completely ridiculous. A recession is a period where the unemployment rate is rising, where people are losing their jobs, where people cannot get a job. And so you get into this vicious cycle where people lose their jobs, so they stop spending. So businesses do worse, so they have to lay people off, which creates more unemployment, and so on and so forth. That's what a recession looks like. This is not what a recession looks like. Now, I'll give you the fact that, we may be in pre-recession. I don't know. Nobody really knows that, but we're not in a recession. Now, one indication that we may be in a recession is the goods spending breadth. And that is how much people are spending across categories of goods. And you can see that we did see a collapse here over the past few months, meaning really that the breadth of goods spending, how much people are spending on goods across the board, that has been faltering and coming into lows that really has systematically been accompanied with recessions. So you really can't understand this idea, this concept, that it doesn't really make sense to say that we're not in a recession, because good spending, the consumer, really is behaving as if we are in a recession. So logically, you'd expect that a recession would follow. And by the way, those gray lines are the recessions. And you can see every time the blue line drops to the level where we currently are, never has it happened without a recession. So is this time different? Well, I know those are dangerous words, but perhaps this time is different. And let me just show you this. And this is, deep macro stuff. And this is what I mean when, we're trying to bring this to the individual investor. I know this may all sound very complicated, but in the end, our job is to funnel all of this information into price targets, model portfolios, video summaries, articles, and really try and make it as accessible as possible to everybody. But you'll quickly see where I'm going with this here. This is good spending, or real good spending, so adjusted for inflation. That's in black, so you can see it oscillates up and down, and you can see periods where it's going down. The unemployment rate is rising, and it's usually during a recession. Good spending going down and unemployment rate going up, and it's usually a recession. Good spending going down here, unemployment rate going up right there, and that's a recession. So you can kind of see the pattern here. When good spending goes down, that's usually when the unemployment rate is going up, and that's usually during a recession. But you can see here, very interesting, right there, collapse in good spending that we saw throughout the end of 2021, the first half of 2022, really. But you can see the unemployment rate stayed low. In fact, the last unemployment rate reading came at 3.5%. So that's a pretty impressive number, suggesting unemployment rate is not rising, at least not yet. And you can see here, right there, if we zoom in into what happened in the last couple of readings, we've actually seen good spending pick back up again here. So you can see that here, we're kind of in a situation where we've really just had a rebalancing of spending because of COVID, because people spent too much during COVID. Now that rebalancing is done, spending is normalizing. And so perhaps this is going to delay a recession, that people are going to go out and spend again because perhaps inflation's coming down, gas prices are coming down a little bit. And so people are perhaps becoming a little bit more confident in the economy, and that's going to delay any type of recession. I'm not saying a recession is not going to happen. A recession always eventually comes. And I think with the yield curve inverted, with the Federal Reserve currently hiking rates at the pace that they're doing, a recession is going to come in the next couple of years, within the next year or two. But are we in a recession now? Are we going to see the unemployment rate rise like this imminently? I'm a little bit more skeptical of that, which is why we're not currently betting on a market collapse. Right, and you can see right here, this is good spending, not adjusted for inflation. And you can see we did see a collapse here throughout the month of February, March, right there, very, very weak readings. And now we're getting a bounce there. So spending is normalizing. We're currently at the same levels that we are typically at during, a strong period of economic growth. Now, if we quickly take a look at the technical picture. So that's where we think we're currently at from a macro standpoint, from a recession standpoint, hopefully giving the other side of the coin. So I think this was mainly an episode to open your eyes regarding different possibilities, different outcomes, because really I've never seen one moment in history where the media, where consensus, where most people have been able to anticipate and prepare and understand that a recession is coming. And right now, it really does seem like, the vast majority of people just accept, yes, a recession is coming. That's a general fact. Most people agree on that. Now, it could very well be the case, but I think you should keep a skeptical outlook on those types of things. Imagine other possibilities that perhaps a recession may only come later in 2023, and a lot of things can happen from a price standpoint between now and then. From a technical standpoint, we are going to be posting an update on the website most likely tomorrow as we get the price action of the end of the week very, very quickly here. Promising bullish momentum here that could morph into something in the short term. We did have a breakout here of this short-term downtrend line. It really doesn't look all that convincing for now, and the primary reason for that is because yields are still moving higher. Let me quickly show you that. This is the 10-year yield that's really pulling the market down essentially. Now, I do think that we're seeing momentum fade in a big way. When it comes to bond yields, I think we're essentially becoming flat here, and bond yields are vulnerable to rolling over, not necessarily collapsing, but moving back down into this range here. Exactly when that happens, that's difficult to say. Could it happen now? Could it take another few weeks before we get that type of correction? Possibly, but that's kind of what we're looking for right here. This type of move would be very good for the market, right? As yields move higher, the market moves lower. That's the type of market environment we're in. Fading momentum on yields has generally been favorable to the stock market. I don't think there's a reason to expect that if yields were to reverse here, which isn't the case. Again, I want to reiterate, we haven't seen a real reversal in yields yet like we saw throughout the summer here. But if we do, that would definitely be a net positive for the market when that happens. So, of course, we'll be continuing to look at that in detail. I do hope you guys enjoyed this episode. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.